There's a few strategies that you can use to help hedge against the negative impacts of inflation on your portfolio. Inflation is a problem because it erodes value, it erodes your purchasing power. So let's imagine you have $1 and you can buy a pack of gum with that $1. Now inflation would be next year, you're going to buy that same pack of gum and it costs you $1.20. Now if you imagine that same process throughout the entire economy, you can imagine how your purchasing power goes down over time. Now you know why having growth in your portfolio is so important. We're going to go through 3 inflation hedges. The first one that we're going to talk about is gold. The reason is because gold has a variable price in US dollars. As the US dollar goes down, typically the price of gold tends to go up. But there are a few considerations when using commodities in your portfolio. Let's bring up a chart. Now this looks like a pretty decent chart. People who've held gold have done well over the period. But hold up, let's look at a slightly longer price range because of course it depends on when you bought it. The problem with commodities is that they're volatile. Looking at this next chart, you can see that from December 1st, 2000, it went from $200 US all the way up to $1,800 US on July 26, 2021. And yes, the long-term performance has been good, but it very much depends on when you bought it. So again, with commodities, they are volatile in price, and you also have to be aware of potential carrying charges if you're physically holding the asset. Number 2, real estate is a very effective hedge against inflation. However, keep in mind, this is a cautionary tale. We're at the bottom of the yield curve, and if interest rates rise rapidly for people that are holding REITs in their portfolio, the yield may become less attractive. Or if you have personal real estate holdings yourself, and you have any kind of mortgage debt, if interest rates rise rapidly again, that could work against you. Number 3, last but not least, my favorite hedge against inflation is stocks or buying individual companies. They have one of the greatest growth potentials over the long run, and there's something there for everyone. The investors that are most at risk for the impacts of inflation are fixed income investors. This is because their payout is generally fixed until maturity. This doesn't mean you don't have to have bonds in your portfolio, but it means you should try to have some portion of your portfolio dedicated to growth within, of course, your risk tolerances. I'm Anna Hilberry. Thank you so much for listening.